Wednesday. Hey, good morning. Wednesday, March the 6th, 2019. This is your daily Forex trading strategy session brought to you by tradersway.com, hosted by Forex.Today. Let's go! Ni hao ma. Hey, good morning, everybody. Welcome to the webinar. My name is Wayne McDonald. I am the Chief FX Market Strategist for tradersway.com. So nice to meet you. Thank you for being here. Thank you for subscribing to the Forex.Today YouTube channel. If you're new and you want to be invited, all you have to do is subscribe. What happens is I click Start Stream, and you'll get a message probably on this device. Pa-ching! Hey, there's a webinar with Wayne. Do you want to join? Do you happen to be available? And you're like, hell yeah! Boom! Brings you right in. Easy peasy lemon squeezy. Once you're here, I want to cover yen pairs, dollar pairs, gold and oil, and all that kind of stuff. Macroeconomics, microeconomics, whatever you want. How many utils does a euro provide? Guess it depends on taste and preferences. Ask questions. We can do technical analysis. We could, yesterday we had our standard chart. Then someone came in a little bit heckled and said, oh, you don't need any indicators. Oh, you don't. Oh, great. So then we went naked, and that's fine too. But whatever, man. My way is not the only way, but my way does work. And then we can fold in or take out whatever you want. I just want you to be a success. Once you become a success in the sense that you feel confident in your skills and confidence in your ability, and you want to start to trade real money, I hope because of these webinars you've found success and therefore pay it back by opening an account at tradersway.com, funding it with real money, and choosing Traders Way as the prime broker to your successful Forex trading business. That's it. Symbiotic relationship. They want you to succeed, so I am here. And once you find your success, you need to go there. Tradersway.com. Without further ado, let's jump into the charts. Azabu said, hey, how about all yen pairs? Okay. We said 3 months ago, 2 months ago, 1 month ago, 2 weeks ago, 1 week ago, that the yens were maybe, plausibly, start to move in one particular direction, starting, I don't know, around the 1st of March. What direction was that? Up or down? Yen pairs up or yen pairs down? Huh? Yen pairs up or down? Okay. So Japanese yen up, yen pairs down, right? Because it's a denominator. Okay, cool. Just checking. So let's start with, I don't know, Aussie yen. Okay. I was caught up in my job. Didn't see what's going on. Yeah. But now I know. All right. Cool, right? Huh. So here's the first day of March. That's interesting, right? Okay, cool. But notice this. Not only is this a top, this is the WM3. Okay. This is an MM3. So on a weekly basis, we said based on this line here, we will go to this line here. Oh, snap! A whizzle. Never mad at the fact he's corrupt like a senator. Yeah, look at that, man. Holy smokes. Nice. That's a good start, huh? Straight up the, right? That's textbook, man. Textbook. Okay? Then on a smaller time frame, you'll see, okay, there's your Sunday, Monday entry. Here's the drop. Here's the retracement. Boom. Nice. Yeah, good start, right? Cool, man. Cool beans. It's amazing. Like, think about it, guys. Like, look where it stopped. Spent all these hours right there, straight out of the textbook. I mean, does that bring confidence that it's like exactly this and exactly this? Cool, man. Cool. Well, that's a good start. Hey, yeah. Hey, yeah. Cool. Well, you have to fold multiple time frames in there, right? This is daily M3. The target, well, more specifically this, but generally this, was hit and for several hours hung out there and then dropped down to the weekly M1. This is daily M1. Okay? And that's called a moo trade, if anyone remembers that, or if anyone bought the book. This is a moo trade. And what a moo trade is, you keep selling until the cows come home. That means the end of the day. You really, you don't like this? See, I think I'm a beautiful singer. I think everyone has a hearing problem. I think that's I think, what's wrong with your ears, Caddy? Must be cultural, I guess. Yeah. Hey, you like how I sing? You should see me dance. Oh, just natural, man. I just look so comfortable. Just in my groove. No, they do not. No, mood trades are not weekly and monthly. No. Okay. All right. So why is that Aussie? Oh, it's Aussie, Kiwi, and CAD Swiss. This is a mess. All right, let's clean this up. What was I doing? Oh yeah, CAD yen. Okay. This should not be daily. I'm going to put that as a 15. And let's put this as daily pivots. That should not be 4 hour. This could be like a 5-minute chart. So let's also make that daily. Give this a little more real estate. CAD yen. Okay, that should be like a 1 hour. And let's put weekly and monthlies. And this should be a 4-hour. Let's change this to daily monthly. There we go. Cool. So strategy starts high, right? You start with your AWAC. AWAC says if you're a bear, that's the plan stand. There's your strategy. Whoop, whoop. I know, huh? Takes a long time to develop a strategy. All right, so there's the strategy if you're a burr. I do remember talking about how unfortunate that was, but that's how it goes. Okay, great. So now what? You can go into the hourly. So what's the weekly play? The weekly play is, here's your sell zoning. Okay. So here you have weekly M3, monthly M3. Cool. So weekly target is here. Monthly target is here. What we saw on Aussie was more of a move, like it was down, it was up, and then it was down. So we didn't get that, did we? So the next plan, if you're still a burr, you're going to look for like this and like that, right? What do you think? Now, if you want to be a bull, this is not the setup you're looking for, but you are eyeballing the weekly M2. You're eyeballing it. So I think what you would like to see here is a double bottom before the up. Okay. But isn't it curious, though? Right? Isn't it curious that for 9 weeks it's been generally up, but this whole time, even way to the left here, even 3-4 months ago, we were talking about somewhere around March to the end of March, this should head down. So this is 9 weeks here of up, up, and then up, and then right on our day, down. Ha! Seasonality. Seasonality. Isn't that cool? I mean, seriously, we talked about this for months and months. So we don't know if it's going to go all the way, of course. But once again, we talked like this could drop. It's whether you put the plan together. Remember? I said the crystal ball isn't important if you don't put your plan together. If you don't prepare it, if you don't trade it, then there's no point of having a crystal ball. Okay? It's what you do with the information that's important, right? Yeah, that is true. The only thing that was wrong, Jimbo, was the velocity. But Jimbo, if you had set the trade up, you nailed it. Okay? And then, Jimbo, not only did we prepare for months in advance that the first week the stock market was going to drop, but we also said that by the third week there's going to be a false rally where it drives its way maybe as high as a double top. So if the plan was the first week it was going to drop and by the third week it's rallying or recovering, I mean, that's a general strategy. That's a general sort of hypothesis that then needs the micro level tactical entries and exits. But isn't it helpful to think to yourself, today's the last week. Today or this is the last week of 2018. I think I should get out of all my long trades and start getting short. And then 4 days later, the market drops 20%. Well, Jimbo, no, Jimbo. We don't know velocity. We don't even know how far it's going to drop. Okay? So remember, the way that the markets work is that if the markets are going to clear themselves out, we don't know how fast it's going to clear out all the trades, but it's the idea that we know when traders are going to clear out of their trades. In this case, a 20% drop in the stock market, bro, that I talked about for months and months and months and months and months in advance. Weeks and weeks and weeks and weeks in advance, days and days. It's coming, it's coming, it's coming, it's coming, it's coming. And then, boom. I mean, dude. Now you're like, well, but, it didn't fall in the way that I liked, and then it reversed too quick. Well, dude, welcome to the world. Okay? And if it fell too fast or recovered too fast, well, that's really unfortunate. You need to take responsibility for your own trading. I don't know what's going to happen ever. I didn't know that this was going to happen. We just happened to talk about it for 3 months straight to get ready. From March 1st to March 31st, the yen pairs are likely to get strong. How strong? I don't know. What day? I don't know. When is it going to reverse again? I don't know. But that's not helpful? Being prepared for this? Come on, Jimbo. Well, if you were short, you got paid. Okay? Also, some people might be thinking that, let's say the market was like this, and then it would drop, and they think it's going to be like this. I'm also saying, look, don't plan for this. Plan for a false rally, and then, how would you call it? So, again, sort of back into a consolidation mode, right? Right? Or like, how about this, Jimbo? The summer, we are going to consolidate this summer. We're going to lose volume and volatility this summer. Find a way to, if that's the strategy, like, do I actually know what's going to happen in July? No. But if you have a hypothesis like July, we're going to have low volume and low volatility. You can carry that out into a plan, right? Again, imagine you're the guy from Billions, right? And you're just this genius, and somehow you can see 5 moves from that. What do? Short the VIX? Maybe use options and straddle the market or whatever. But if you have a hypothesis, you should be able to put action behind that, right? And then what about in July when everyone's crying and people are on TV going, oh man, the VIX is at an all-time low, and maybe we shouldn't be using VIX anymore, and maybe we should have a different indicator, and oh, it's so hard to be a trader this year, and oh, I think bonuses are going to be low this year. What do? You buy the VIX. Why? Well, if it's at an all-time low, it's probably going to go up when volume and volatility comes back, right? Like all these things. It's planning for tomorrow, it's planning for next week, it's planning for next month, it's planning for next quarter that makes you become a successful trader, because now you're in situations like it's been up for 9 weeks. But for whatever, we have a hypothesis that somewhere around this day, actually, isn't that amazing? On somewhere around this day, the hypothesis is we believe, or I believe, Japanese yen is going to get strong, and I can explain why. How fast? How far? Don't know. It's not up to me. I'm not moving the market, right? Right? So again, Jimbo, we never know how far or how fast, but you can have a hypothesis. And if you put trade plans around it and put trades on it, you can make money. Of course, you can lose money. But you need to be there. Watching the market do what you had planned on doesn't. Okay? So, yeah, January, that was shocking. Hey, I didn't even see October coming. The October unwind was shocking. Huh. Okay? That's where things like politics and stuff get involved and all that kind of stuff. Okay, like this July, maybe it's in July that China and the United States announce a deal and the stock market rallies. You can't come back to me and say, Wayne, you were wrong about July, man. It was supposed to be low volume and low volatility. Look at the stock market, man. Like, all right, well, yeah. No, absolutely not, Jimbo. Once again, you got to take responsibility for your own trades. Cool. And by the way, Jimbo, so I don't know how long you've been trading, but there have been years where it didn't matter at all what yen pair. Not at all. You could just blindly close your eyes, find a yen pair and long it in August and September and October and make money. Not every year is that way. That's why you got to take things into account. Where are we now in the macro scenario? What are the differentials? What in interest rates? What's the differentials in central banking policy? Where all that kind of stuff comes into play every year, and that's you need to do your homework for that. So don't think it's just as simple as walking in, longing all the yen pairs, and you're going to get rich. Couple of interesting things. Is it the 10-year German note or 2-year? Anyways, it's a 5-year anniversary, I think, of the 10-year German being negative. Is that right? And today is the 10-year anniversary, like to the specific day, the S&P 500 hit the low, 666. Oh, Gao, get out of here. Stop wasting our time and breathing our air. Gao Jai. What a scumbag. What a world we're in, huh? You see that idiot? Hopefully he didn't. He's gone. All right. Jimbo, you don't think we talked about these things then? Really? Oh, he was trying to scam you into sending an email to someone so that he can manage your Forex money for you and make big profits, big time profits. Just the same crap that gets posted on all my videos, all the spam comments. It's crazy. Like when you're in the back end, YouTube blocks as many of those as possible. It's something like 28,000 of these things have been blocked. Just amazing. But okay, cool. Anyways, yep, trading is tricky. Every year is different. Every year is the same. To what degree is the trick, I think. Anyways. Okay. Here's the counter trend on a Friday. Here's the first trade of the week, the second trade of the week. Notice how we opened out of position. So if we're going to use this and this as a guide, this is the sell zone. So, that's why I say we open out of position. Unless you traded like Asia Open or something, I don't think you would have. But anyways, that's interesting, right? So you have to take into account that it didn't open high, which is what you'd like, right? Oh, no. I didn't mean to come across like I was attacking you, Jimbo. And if I did, I apologize. I haven't slept very much, so I'm exhausted. So I apologize. So the question is, how do you play this S1, right? I don't know if I really want to play that S1. But this is the better sell zone here. And then if it's down here, how does this play? And that's definitely support, right? Okay, cool. Right on, Jimbo. Yeah, Euro Yen. Sorry. Yeah, there's no watermark on this setup. But you can see like the classic setup here is using the moving averages. You break through the MAs, you back into the moving averages, you break out of the MAs. Now the 21's in control, which means you're still bearish and aggressively bearish. This means you're bearish but conservatively bearish. So if you're still a bear, you're going there and taking this down. Therefore, you have to ask where you are in the larger cycle, right? And these are all weird. Let's go to this one. So where are we on the larger cycle? Well, this is the confusing one, right? This is your M3 here. So this has just started, but this is the weekly M3, and this is perfect play. So your plan for the week is probably something like that if you're a bear. Now you're going to have to worry about all of this. Okay, and this is where we are now. So there's this as a plausible play, and then of course there's this as a plausible play if you're a bear. If you're a bull now, let's do it this way. You have to ask yourself, for example, where's the support? Well, we definitely have support there. There's definitely this play, which is your standard operating procedure monthly swing, right? I guess the question is, are you going to take this sort of micro move? But it's an M2, not M3. Well, it's, how do you say it in English? I guess I have to spit it out here. Okay, you connect all of this, okay, and this is a weekly M2, which gives you permission for this, but it's out of position on a monthly basis. And that's kind of how we started this. This is a nice this is a nice weekly sell, but the monthly sell was here. So, this should ideally be lower than it is. And same thing, like this is legitimately weekly support, but it should be a few, like I wish I could grab this whole market and move it down 100 pips, right? It's just they're not quite lining up. But yeah, if you wanted to be a bull, especially on a weekly basis, you could take this. And I suppose if that don't work, then you're going to try this. And if that don't work none, you're going to try this. So you really have 3 plans. Each one sort of like you don't really want it to come all this way down. But if it came up and then dropped fast and furious to this level, then I would plan for that recovery. Right? So it's almost like you might even skip one by using your stop management or something like this might work. But if it doesn't and it drops fast, so it does, let's say this and this, then you're going to very quickly look for that. Okay. NP says, what are my thoughts on Elliott Wave? I don't trade Elliott Wave. It's mostly, from my limited understanding, there's a lot of like Fibonacci retracements and some price action into it. Cool. But it's too rules based for my personality. I'm an entrepreneur, so if you give me a bunch of rules, I just automatically find all the flaws and want to change everything. That's what entrepreneurs do, right? So counting waves and stuff just sounds stupid to me. But Elliott Wave, I'm sure, works just fine because I can see the price action, I can see the fibs. So sure, if that's how you want to do it, it's just too mechanical for me. Oh, so whatever. So yeah, if it fits your personality, if you're an accountant, boom, do some Elliott Wave. I'm saying, Banda, that some weeks you have perfect setups, and that brings you confidence, where you just see overlaps of weeklies on monthlies, and you're just like, oh, yeah. And then other times they don't perfectly overlap. So, Banda, what that does is it just gives you a higher level of risk. What you do with that knowledge is up to you. Do you take it? Do you skip it? Do you put half a lot size instead of a full lot size? Do you scalp into it? All this kind of stuff, right? So there's no one easy answer. You should just look at it and go, ooh, they don't overlap as much as I would like. And then make decisions. Knowing that it's important information is important information. Okay? Okay? So for example, if you were a bear and you were trading this, you're going to be very interested what happens in the next few hours. So you can see we had one bearish hourly candle. Now it's a green one. So the next one should be down, right? So that's going to be what? A retracement. So you want to look at sort of the move we've had over the last few hours. Okay, you want to set it up like that. You also want to use price action. You're going to take that old support and drag across. That's your new sell zone. So ideally, you're selling as long as you're below that. Okay, because you have the larger dynamic level of resistance, right? So that's just classic. You're trying to get short off the 21, trying to get short off the roll reversal, trying to get short off the 3A2. Okay, now it could do this, and that would be very undesirable. Okay, so you have to ask yourself, what are the chances? Like, what's the probability? Do you think this is 60%? Let's say 60%. The percentage is 60% it goes down and 40% it goes up. What would you say in this scenario? What's the probability of up versus down? It's a question, guys. Would you agree with 60-40, or would you do 50-50, or would you do 70-30? what's the percentage of down you would assign? Now, James says 60% seems right, but think about it. If 50-50 is an example of range bound, is this range bound? So like, is this 60-40? Could it be 65-35? Could it be 70-30? Right? So you guys are now, this is what traders do over and over again. Yes, it does depend on your bias. It's subjective. This is not rolling the die. There are not 6 equal chances. So it's very subjective. Okay? So you're going to have to use your years of experience and voodoo magic. I don't know. Whatever. You make a decision. Okay? Now, how should this affect the number of pips? Okay? Could you have a 33.99 OCO? Right? 33 pip stop, 99 pip limit. Could you have a 50-50? 50 pip stop, 50 pip limit? Yep, straight out of the book, Jimbo. Right? So this also, I mean, this is what we're looking at trading-wise, right? So if 60% of the time, let's say you win and 40% of the time you lose, okay, that's some important information. What if your winners are twice as big as your losers? Well, Michael says the target's, well, if you're trending, for example, right? If you're trending, let's say it retraces 50% and then expands 100%, right? That's why you get a direction. If there's no direction, it's 100% up, 100% down, 100% up, 100% down, 100% up. So in this case, it's 100% down, 50% up, 100% down, 50% up, 100% down, 50, right? So you can look at that and say, well, you're picking up more of these. So if you're selling in a downtrend, you should make more pips than the retracements give you, right? Banda says it depends on your risk management. Yeah, well, this is why I'm making the point. Is it fair to say at the bare minimum, let's say your average loss is 33 pips, but your average winner is 66? And if I point that out and you say, well, Wayne, I agree. Oops, come on, drawing tool. You say to yourself, Wayne, I agree with the minus 33, but my average win isn't 66. It's less than that. Then you just discovered a problem. Okay? Okay? But under this scenario, guys, if let's just say your average loss is 33 and your average win is 33. Do you make money under the 60-40 idea? Yeah. Well, James says a little. Ron says no. Actually, you still are. You're winning more than you're losing, and you're losing the same amount as you're winning. So 20% of the time, right? Oh my! You guys are so funny. You lose money on commission. I mean, I've seen people lose, $20 million a day, and it's nothing to them. So imagine just even under these rules, you're trading, you have a $2 billion account, and you're like, oh, well, we only make money 20% of the time, and we break even on everything else because that's what's happening, right? 20% of the time you're losing money, 20% of the time you're making money. Well, actually, 33% of the, well, whatever. Anyways, you make money. But you don't make a lot. I mean, it's funny, like, you don't make a lot, but again, if you had $2 billion, you're like, oh man, I only made 200 million last year. I really need to improve, right? It's just funny how things work. This is the next secret to all of this is upping this from plus 33 to plus 66. When you're right, try to be righter than you are wrong. Try to get your winners to be larger than your losers. Okay? So try at first to go from minus 33 to plus 33. That's okay. And therefore, you're just eking out on a winning percentage. But you don't want to do that, guys. Winning percentage will not pay your mortgage. Winning percentage will not put your kids through college. That's essentially, it adds up to scalping. Okay? It's income-based, but it's not wealth generating. Okay? So the next thing is get this to plus 66. Have your winners be twice as large as your losers. Make it a conscious effort to try. And if you're not doing it, ask yourself why you are not doing it. You might find that your entries are so piss poor that there isn't that many pips left, or something like that. Or you're not planning on a higher time frame. You're not finding the bigger support. Or actually, what I often find is people find it easier to counter trend for some reason. It's built into some people, and in fact, a lot of people. So it's not an unusual thing at all to think it can't go any farther. It's going to reverse now. And for some reason, even though it's trending beautifully, they counter trend it. They keep trying to reverse it. Instead of just buying dips, they're selling rallies, and like, that takes a long time. Well, if you're doing that, you're going against the trend, and you're going to be lucky to get 33 pips, probably not 66 for what I just explained, right? For some reason, people just want to buy this and buy this. I guess maybe that's why it all works eventually. But then once you get to this, really start to try to get 99. Try to get 20% of your trades 99, 40% of your trades 66, okay? And 40% loss or break even, whatever, that adds up, right? Okay? And what you'll see is you will find, I like, give it a year, like, get a good sample size. I think that you will find over time, your trades don't actually change that much. It's not like you have to be a better trader per se, but allowing sort of the compounding of Forex, the compounding of interest and payments, and catching better trends because you have better planning on a higher time frame, getting better at things like seasonality and stuff so you can plan. Your trading won't be any different really on a smaller time frame, except for you're very focused on allowing your winners to run. And you'll see, though, if you stay at this 60-40, 60% of the time you win, 40% of the time you lose is now what it's talking about. Your winning percentage is that. But you get from a 1-to-1 win-loss ratio to a 2-to-1 win-loss ratio to a 3-to-1. How do you get to 3-to-1? Well, in certain times of the year, let's say in the third half of the year, you get these yen moves, and yeah, instead of making 2,000 pips in a month, you make 5,000 or 6,000 pips in a month, and your averages go up. But the thing is, you're consciously focused on it, and you'll see that the only thing you're doing different is knowing when to let your winners run even further. Okay? Okay? And you'll see like your profitability just skyrockets. Not because you're a better trader, not because you have inside information, not because of some unfair advantage, just simply letting the trade plan work. Things like not just trading day trades. Day trades I love, by the way. Day trade, day trade, day trade. Love it, love it, love it. Especially in a good trend. Love it. But get some swings in there. Get a weekly swing and double up just because you're in it for the same trade, you're in it for 2 or 3 days and not just 2 or 3 hours. And then these monthly trades. Some of these should be, like a monthly swing. I plan them out every month. Some of them are like 300 pips. More often lately, they're more like 200 pips. But I'm talking about just trying to let them run for 99. But if it's a monthly trade plan, some of these should be 199. And it adds up over the period of a year. You will, the difference, it's hard to explain. It's not like you make twice as much money because your winners are twice as big. It's actually compounded. $60 is okay. But you don't need the 60-60, right? So again, let's look at it that way. What if half your trades are losers, half are winners? I don't think that's very good, but that's fine. But your average winner is -33, and your average loser is -33. Your average winner is +66. So on average, on every trade you make, you expect, the expected utility of a trade is equal to +33 pips. You expect, no matter what, you're going to make 33 pips. Boom! Snap! But if your average winner is only 33, your expected is 0. Big zip, zilch, nothing. There's a big difference between +33 and -0. Oh, come on. +0. Okay? So once you figure out little things like technical analysis, focus on being a better trader. Ask yourself, how can I? First of all, do you even measure what you're doing? How are you supposed to get better if you don't even measure what you're doing? It's like a chicken running around with its head cut off. You're just making a big bloody mess. No one wants to look at that like, oh my God, look at his trading. Oh, gee whiz. Ooh, right? No. You got to measure if you're going to get better. So how do you get from +33 on your trades to +66? Well, better entries. But I bet you anything it's risk management. When do you move your stop to break even? Question mark. Do you even move your stop to break even? I often find myself a better trader when I say like this, for example. I say, I think there's more chance of this going down than up, so I'm going to sell in here, right? Which looks like you may have already missed it. And I'm going to put my stop here for whatever that number is. I'm not even looking at it. Okay. And I am not going to touch it. I don't care, because it could do this, it could do this, and almost touch it, and then almost touch it, and then come down. But I say to myself, I think the odds are it rolls over. I don't know if it's going to take a day or an hour. So I'm willing to lose 33 is what I often, I don't always, but I often say I'm willing to lose 33, because if I put the stop here and then I move it and it goes like this and then this and then this and I get knocked out, well, I threw away the opportunity, but I took the risk, right? And my analysis tells me most of the time it heads down. So like, why am I so fearful? So the sort of the mental, if you want to talk trader psychology, the trader psychology is I'm willing to lose 33 on this. But I know this is worth 66 or more. Or more. And I'm happy to take it. I'm happy to take the risk, right? Because I look at the higher time frame now and I say, well, the bare minimum target is going to be this monthly. Okay. But this is an M3 up here. So this is plausibly going down to this green zone. So why the heck would I get out here? You know what I mean? Like, think about it. People are like, they get out here and they're like, I made 33 bips. You're like, dude, that was the trade, right? Like, what are you doing? So you try to let the plan run, but you have to have the higher time frame. You have to have the bigger trade idea, all that kind of stuff. Like, and that's why I look at this and I go, okay, this is a perfect weekly M3. I love that. I love this. This makes me happy. This monthly M3 does not make me happy. So my confidence level that we're doing this is lessened, is less. I'm less confident as I could be if the weekly M3 was here and a monthly M3 like we've seen on other pairs. My confidence is much higher. And, I'm going for gold here. I'm going for it. I want the pips. You see what I mean? Yeah, Banda's asking, can you compound by just adding more and more? And that's where multiple time frames is important. So, Banda, if this is my trade plan, and it should keep going to we hit the bottom for the month, right? Then my weekly trade plan is this, then this, and then this for next week, so now I have a monthly, which I can't even see the bottom. Now I have my weekly, which I planned out this week, and then, of course, next week's weekly, which is important this week. And then, let me change the color one more time. Is cayenne a good one or magenta? I guess let's do magenta. Now on a daily, now I'd have to add daily pivots. I might see something like down, down, right? And it's not just one sort of weekly swing, monthly swing, and then the weekly swing, but then there's the daily swing where I'm looking to sell high on a daily basis, and I call it an Asian fade. So typically I'm doing Asian fades, trying to pick up daily. And so the question is, well, how do you add this all together? Well, this is a day trade, and you can let those run. And then you have your weekly trade, and you can let that run, and then you have your monthly trade, and you have that run. Do you let them all run? Sometimes I do, depending on what I'm trading, why I'm trading it, and when I'm trading. Is that a March play? Well, if your confidence level is high on the repatriation idea, And if the stock market's falling hard, yeah, I could be talking to that. Typically, if we're talking end of the year and we're talking about yens and we're refunding stuff and releveraging, because this is a deleverage play, if I'm creating a re-leverage play, I will try to let them run. So here's one way I might do this. Let me again change the color of my pen. I might do something like take profit on the day trades. Okay, so Asian fade, take my money out. Asian fade, take my money out. Okay, and I won't compound them. And the reason I won't compound them is I'm also doing the weekly swing, so I already have that. Okay, so like you pick up, let's say, 50 pips here, because remember you want to average 66, but I'll show you that one. So you want to average 50 pips here, and then the next day trade, you pick up another 50 pips. The third day trade, you pick up another 50 pips, okay? But you make on your weekly swing now, you take the whole kit and caboodle. And this probably is moving, and this was 50 pips up here. So, it moved 200 pips. Of that, let's say you collect 150 of it. So now you got to do 5 trades, or you got to do 50, 50, 50, 50, right? 200, 3 plus this, 350 over 5, and you get an average, okay? And then your month would, right? If you get a good entry on the month, I'm going to try to sit on that. So because I'm making money on the day trades and the swing trades, if the entry is good on the monthly now, I might just put the 33 on that if I get a good entry. Because remember, it's going to be the same entry here, but I might say, okay, well, this is an M3. So on the M3 one, the monthly M3 one, even though it's a day trade, I'm going to have the same stop because it's a day trade. But that one I'm going to let run, and I'm going to just let it run all month. So I don't care if it's up 150 pips profit. I might not move the stop to break even. But if it comes down to here, I'll probably move my stop. But the thing is, there's at least one trade, even though there's like 5 euro yen trades, I'm going to try to get a 6th trade now with a plan of the full 300 or whatever, right? If I get this MM3, and I'm short daily, I'm short weekly, I also want to be short monthly, but I'm going for the MM1, and I don't care what happens. I either hit it or I don't. So it becomes almost binary. Okay? Does that make sense? This is why I teach you multiple time frames, because there isn't just one thing. But I can guarantee you this. If all you do is day trade, picking up, let's say, 33 pips at a time on average and risking 33 pips on average, the only way you're going to make money is increasing your winning ratio. So you're going to have to become ridiculously good and accept very little reward for your amazing skill. Eventually, you'll either become unlucky or tired. Do that for 3 years. All you're doing is making 33 pips. I'm telling you, even if you're like 80 or 80% winners, what happens is you just get tired. It's so hard. It's so hard to work that way. I mean, you're just strapped to your chair. Like I told you the other day, there was a time in my life where I wore the skin off my tailbone because I had sat in front of my computer for 3 or 4 days. Like, I try not to do that anymore. I don't do that anymore. And it was because I was working hard for my money, not getting my money working hard for me, which is the difference between income and wealth. So, and here's really, 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 really the big risk. Even if you're 80% here, because you got skills, right? Girls got skills. Great. One day, you just get sick of working so hard and you're not making any real money. You start to make mistakes. Not that your technical analysis is bad. You start upping your lot size. Why not? Hell, 80% of the time you're winners. Which is another form of increasing your leverage. And that is the day you throw your career away. If you don't move to the idea of you got to get more pips because your plans are better, right? How do you get to the plus 66? How do you get to the plus 99? If you never ask yourself that question, and more importantly, actively try to get there, then one day, even if you're an amazing trader, your immune system, if you will, your shield of discipline will break down. And one day, your confidence will lead you to your failure. Okay? Renko, that is what we're talking about. Okay? In my book, I actually talk about lowering your risk percentage-wise and lot size-wise. So in the beginning, you might risk, let's say, one lot for every 10,000. I'll just make up a number. And then by the time you slowly increase your lot size, okay, over time as your account grows, and then you get to 2 lots, but you have 33,000 in your account. Okay, you've doubled your account, or you doubled your lot size, but you've tripled your account. So let's just do 30, right? So per trade now, you're making twice as much money, but the risk is less. What's the number? It's 33% less risk per trade, but twice as much money earned. And then you get to 3 lots, but now you have 90,000 or maybe even 100,000. So on a percentage now, it's even less. It's down to 60% of what you used to trade here. You have 40% less risk than you started with, right? So that has to do with diminishing risk, right? How would I draw this if I was a Harvard student? Let me think of this. Diminishing risk, right? So you have to, let's do a chart. This would be money. Wait, is this money or risk? Which one's risk? This would be risk. So we'll do this risk, leverage or risk or whatever, and assets under management. Money. How much money? And wait, that's not right. Assets. Anyways, I'm trying to get to, like, you get this idea as the. Is that going to be right? Yeah, this is risk averse, right? I'm wondering if actually it'll be shaped differently. But anyways, what I'm trying to get to is as your account gets bigger, the rate of which you add risk, right, gets smaller and smaller and smaller, right? So for example, let's see, I should do this in a different color. Well, let's do it this way. So here's one level of risk, okay? your account size grows significantly. So now you're at this level of risk. The amount of risk is the difference between these two. And now you quadruple your assets under management. Okay. But the distance between, we'll call this R1, risk 1, and risk 2 is, I don't know, let's just assign a number, 50. And the difference between R2 and R3 is 30. And then and now you double your count again. And there's almost no difference in risk, right? Oops, wrong button. Anyways, so it's a diminishing scenario, right? Anyways. Yeah, well, the 8, Jimbo, is supposed to lag. There's little techniques to using that built-in lag. For example, after a 5-8 cross, you will see there's one more pullback to the 8 for the entry. So it's not the 5-8 cross, it's the pullback to the 8 after the 5-8 cross. Stuff like that. It's lagging purposely. And if you'll notice that one, I change, right? So how do you do this? The 5, oops, come on. Let's do here. This is going to be difficult. Where's the 5? Okay. The 5 closed. The 21 closed. 55 closed. 200 closed. 8 open. Say what? And, right? Anyways. So, it's a simple and it's an open. Why would I go to that much trouble? Because in certain circumstances, it's helpful. Okay. So for example, like after the 5-8 cross, it comes back to the 8, like I just said. Okay. But whatever, you don't need it for sure. You for sure don't need it. You don't need any of the moving averages. Cool. Okay, let's burn through this. Good talk today, guys. Thanks for the questions and all that kind of stuff. And again, I apologize to Jimbo if I was bitchy. I'm a diva, Jimbo. I get bitchy. Cool. Okay, this looks more up than down, doesn't it? This has to do with the US dollar. Dollar's quite strong these days. Look at that move. Is more likely what's happening, especially after the breakout of a downward channel. It's amazing. On the day we wanted to head down, it went up, and that pretty much ruined everything. Cool. So anyways, dead. I'd walk away from that. All right, so now we have in here, check that out. Captain Obvious, but I have to state it. Okay. Why did it stop there? Well, first of all, that's our target. And then second of all, this is where bulls buy. So remember this confluence? We talked about sometimes you have a confluence, right? How about a quadruple top at a weekly M3? Wasn't a perfect here, but it was definitely tradable. Now, how about here? You got a weekly bull run. So, monthly bull. Monthly bull. I'll go M bull. Now, it's not that this is a weekly bull. It's a weekly bear, how do you call this? Bear out? bear out. It's not necessarily bull in, it's bear out, which can lead to a bull in. Bulls buying. This is where bulls want to buy, and this is where bears want to get out. You see the difference? I mean, they're not the same. They're not mutually exclusive either. Sometimes you'll get both bulls buying and bears exiting, but typically a bear will need to exit first and then a bull will buy because a bull's going to want to confirm. For example, on a smaller time frame, this is somebody's trend, right? So what does a bull need to do before buying a downtrend? Needs to wait for a reversal pattern. What reversal pattern will happen? Yeah, good question. Projections in your trading? What do you mean, Fibonacci extensions? Sure. There's probably a whole chapter in my book about that. Oh, is Mike being a distraction? Is that what's happening, Mike? So I'm looking right at the chat then, Mike. If you have something to say, let me know. Because I haven't been watching. I've been actually coaching. But okay. So a bull's going to want to see something in here first. And that's why bears usually get out first, and then bulls tiptoe in once they see the price action. Cool, Mike. Just want to make sure. Watching how you learn how you learn others. My oh my, WTI. Nothing. Yeah. Walk away, walk away, walk away. Where's my gold? So it's just sort of the same thing we've talked about before. This is where bears should exit. Your bearish trade plan should be done. It's very early in the month still. which sets this up for a counter trend. So if you're a gold bear, I'd take my profit and take the rest of the month off. Oh, Banda, not Fibonacci. Maybe I misunderstood. So, yeah, I just didn't understand. Cool. So, anyways, I'm trying to keep up with the chat. You guys are on fire today, huh? So, watch the stock market, I guess, is another thing to kind of leave you with. Remember, that's sort of our indicator right now of risk on or risk off. A rumor or an announcement of a trade deal between the two largest economies in the world that's going to create a stock market rally, regardless of seasonality, because it's not seasonal, is it? I don't want to go too far out here. Yeah, I'm just going to let it play. Seems like there's so much time that you'd have to imagine this sets up a counter trend trade, which gets you back to, I call this the old neckline, which is interesting because it's actually next month's sort of entry, and this will expand a little bit, but this sets up for a potential move as high as here or here. I'm going to put it here because that's more traditional. And then next month, I mean, I don't know. At that point, does it do this or does it go that? Well, based on this, you'd have to assume that for now. But I'm open-minded with gold. So anyways, it's kind of interesting. Bears got what they wanted. This is the target. I think there's a higher chance that bears start taking profit than bears entering new trades. You see that? Does that make sense? That there more bears are likely to take profit than enter new short positions. So if they start taking profit, that gives you some up, and that means this could be up for a week. So that next week's trade could be bullish on gold. And then 2 weeks from now, the world gets short again and ends the month low. Actually setting up next month. So that's actually setting up April. So that could be up, then sideways, and then down. I mean that's called patience, right? We're talking about things 3 weeks in advance, but that's kind of where we are, I think. Mike, I think Sunday night is much more important than Monday night, but I can see how you might play the Monday night because it's already done sort of the first wave, so then you can catch a follow-up and then let it run through. That's fine. I think a lot of the trades actually set up on Friday, but then you got the gap risk, so whatever. All right. Well, anyways, good talk about risk management and how do you say the other side of it, the opposite of risk, I guess, opportunity management, and the importance of it, and having trades on multiple time frames and for multiple periods. It's very, very, very important. right? So bring your good questions tomorrow. I'll cover more currency pairs. Just keep me focused. Remember, I respond to what you guys ask for. So, but thank you for being on my team. I should do it this way. It's more polite. So yeah, thank you for being on my team. Thank you for participating. Very active chat today. Hopefully, you're treating each other with respect as peers. But anyways, thank you for all of that and the likes and the subscribes and stuff like that. I really appreciate it. So what we're getting closer and closer to non-farm payrolls on Friday. Don't forget that. I'll be over at FX Street for that. That's a 3-hour webinar. Cool. Good. Everyone's like good stuff. Really cool. Well, make sure you pay it back. Visit tradersway.com. Even if it's a demo account, take you 30 seconds. Download MT4. Then in the chart description below, you can download my chart templates. I am going to start charging money for them. I'm going to add a few other resources and stuff. So if you want them free, you better do it now. I'm literally having the programmers set up the new process so that you will have to pay money. So I figure 3 months of giving them away for free is a pretty good start. Cool. So what else? I guess that's pretty much it. So once you download those MT4 templates, put it into the MT4 you download from Traders Way, and you're golden. To subscribe, simply click on the Forex.Today logo. And feel free to watch the 4,000 other videos associated with my work on YouTube, since I've been uploading since 2006, I think. So peace on earth. May the pips be with you. May our profits be above average.